All right, it all leads up to this. Now that we know how to calculate required returns from stocks based on their thematic risk, we can use that as a company's cost of equity. The higher the investor's required return, the lower the stock price will be. Remember, that's the discount rate in stock valuation. And that imposes a cost on the company. That's cost of equity, right? So we can put that cost of equity alongside cost of debt. And then that gives us how costly it is for the company to finance its investments. That's cost of capital, right? Specifically weighted average cost of capital. That was the reason why we were doing all this part 6 risk and return, was to be able to figure this out, the Wacc, which is then used as discount rate in DCF stock valuation and used as discount rate in capital budgeting, in NPV analysis, for example, right? All right, so here's our formula. Weighted average cost of capital is RE, cost of equity. And now we learned how to use CAPM to come up with this, right? So required return from stocks. Now CAPM gives us one answer. In practice, sometimes people use other models or other ways of coming up with this, but we're going to use CAPM. So think of that RE, that's cost of equity. That's the required return from the stock based on CAPM. This is the weight of equity in the company's capital structure. How much equity, how much does it depend on equity relative to equity plus debt, right? And this just differs from company to company, differs from industry to industry a lot. High-tech companies, technology companies tend to rely a lot more on equity, and all technology and manufacturing utility companies tend to rely more on debt. So this varies. So that's the equity component plus cost of debt. This is pre-tax cost of debt. For example, the yield on companies' existing bonds, or how much it would take, what interest rate the company would be charged if it needed to borrow money, times 1 minus T, the tax rate. That's the tax advantage of debt. The tax deductibility of interest payments lowers the effective cost of debt, right? Together, this gives the after-tax cost of debt, and then weight of debt, right? So these two will add up to 100%. Okay, so that's Wacc. So here's a question. A company has a beta of 1.6. That will be used to calculate CAPM expected return, which is cost of equity, right? So this is above average risk, so cost of equity will be relatively high. Pre-tax cost of debt of 6%. So again, think of it as the interest rate it would have to pay on new borrowings. Effective corporate tax rate of 18%. That's going to bring the interest tax shield or interest tax advantage and will lower the cost of debt. Weight of debt is 40%. Rest is equity, so 60%. Current risk-free rate is 3%. Will be used in CAPM. Expected market return is 8.5%. Will be used in CAPM. What is this company's weighted average cost of capital? All right. So Wacc is cost of equity times weight of equity. So in the formula, this was E divided by E plus D. If we know the amounts, numbers, market capitalization, amount of debt, amount of equity, we would need to calculate that weight ourselves. But here we are actually given the weight. The lecture examples, there are examples where the dollar amounts are given. Those are important. Make sure to review those. All right, cost of equity, weight of equity, plus pre-tax cost of debt. The tax interest tax advantage is taken into account, and then weight of debt. Right. So now let's first figure out cost of equity, which using CAPM, that's going to be risk-free rate plus beta times expected market return minus the risk-free rate. So that is risk-free rate is 3%, beta is 1.6, expected market return is 8.5%, risk-free rate is 3%. So expected market risk premium is 5.5 times 1.6 plus 3, 11.8% required return from the stock, which is, this is company's cost of equity. So let's plug these in the Wacc formula. 11.8% times weight of equity was given. Rest is equity. Debt is 40. So this is 0.6, 60% equity. Plus pre-tax cost of debt, so interest rate on new debt is 6%, times 1 minus the tax rate, to see after-tax cost of debt will be 0.82 times that, and then weight of debt is 40%, 0.4. All right, let's calculate that. 11.8 times 0.6, that's the contribution of cost of equity, is 7.08. Now cost of debt is 6 times 1 minus 0.18, 4.92 times 0.4, that's the contribution of cost of debt. This plus, recall, 9.048, so roughly 9.05%, is the company's weighted average cost of capital, which is a discount rate we would use to discount future free cash flows to find the enterprise value and walk the bridge to share value. Or this is the discount rate we would use to see if a project has a positive NPV or not. Or in IRR, capital budgeting analysis, we would require projects to have a return greater than this. So capital cost for this company, 9.05%, its projects must return better than this to create value for the company and to be acceptable. Okay, so that's weighted average cost of capital.